Good evening and welcome everyone. Thank you for joining Quantum Mutual Fund's webinar. My name is Vipin Venugopal and I'll be hosting this session. The topic for today is, are hybrid funds an option to FDs? Things to consider. I'd like to begin by introducing you to our speaker for this evening, Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments. Before we begin the session, I would like to request you all to plug in earphones for an optimal listening experience and ensure that you are connected to Zoom audio. I also request you to please type your questions into the chat box, which the speaker will address post this presentation. Over to you, Chirag.
Thank you, Vipin, and thank you everyone for joining us today. I know there is a lot of uncertainty out there in terms of valuing equity markets. Debt funds are losing ground. Gold also had a crash last month. So it's all been a mixed bag, and investors don't know where to park their money at this point in time, whether FDs are still good or do you need to move to alternatives that will help you get better returns, because inflation is surging and everyone needs to protect against that surging inflation. So we will run through a few slides and then we will take your questions. So as we all are aware and feeling the pinch of the falling FD rates, if you look at the FD rates, they're all significantly lower from where they were earlier. So FD rates have been, depending on the tenure, between 3 to 5% and has fallen from the 7-8% that we all were used to a couple of years back. So this has been really a pain point for many investors, especially savers, when your returns are falling, but inflation is moving higher. That really, it's a very difficult times. Until now, over the last few years, inflation was lower, but now there is a good amount of inflation across the globe, and there is a possibility that this inflation could be structural and sticky and be with us for some more time going forward. If that happens, that's again a question of where do you park your money so that you at least make up for that inflation and get a real positive rate of return. So what has happened historically, we have been all been reliant on fixed deposits as a place where we park our money and we get steady returns. And that trend has been persistent since 1980s. If you look at the graph on the right-hand side, it has been about 40 to 60% in that range, our allocation to cash and bank deposits, which has been a predominant way to park our financial savings overall. If you look at mutual funds, if you look at insurance, they have been very small portions of our financial savings, and the bank deposits have been the bulk of our money, where most Indians have used FDs as a money, as a place to park or be invested in. So if you look at FDs, what do they do is give you a short returns. There is deposit insurance, which was earlier 1 lakh rupees. Now it has increased to 5 lakh rupees. So there is some surety up to 5 lakh rupees. And you can also get loan against your FDs. But on the negatives for FDs, you have low returns. Usually the FD returns have trailed inflation. So on a real basis, that's not helped you to up the standard of living that you're looking to, and it has given you negative real rate of return. It's only insured up to 5 lakhs. If there is a systemic problem, then it will not suffice for many of you all. Liquidity is not there, though it is in some sense, but again, it comes at a cost. So liquidity is not free, but comes at a cost to you because there is a premature withdrawal penalty charged by the banks. And the worst is taxation. It is taxed as per tax slabs. There is no benefit. Each and every quarter you earn your interest, you have to pay taxes on that, right? So if you're in the 30% tax bracket, your taxes are 30%, which is significantly higher than parking into mutual funds, which are kind of equity, which is about if you're up to 1 year is 15%, and after 1 year it is 10%. Even there's a denominated amount which is kind of tax-free. Even on the debt funds, it is after 3 years, it is 20% of the indexation, which eventually comes, the tax rate comes down to somewhere between 8 to 12%. So there are efficient products from a taxation perspective, and worst of all, the highest tax slab is on the FDs. And if you look at one thing that has been constant all across our time frames is the cost of living, right? The consumption basket that we all have, be it food, clothing, shelter, entertainment, etc., keeps on increasing every year. So 1990, your household annual spending was about 24,000 rupees. The same consumption basket, the same things if you were consuming all throughout from 1990 till now, would have cost you around 4,27,000 rupees. So that is like a rickshaw or a taxi meter, which keeps on ticking every minute, right? And if you look at year-on-year rates for this increase in consumption spending, is about 10.1% increase every year on an average. So that has been the benchmark at a minimum that we all need to surpass, so that on a real basis, we kind of make a meaningful difference to our standard of living. Gold has increased more or less in line. It has increased by 9.4%. Gold prices were around 3,400 rupees in 1990. Today, they are more than around the 50,000 mark in 2020. Now it's fallen a bit from there, but it has increased by 9.4%. So nearly matching that spending increase that we have seen. Equities, on the other hand, Sensex was 730 in 1990. Today it is 47,000. So it has kind of kept pace, increasing by 15%. So it has helped you significantly to add or beat that inflation increase that we have seen all across. And fixed deposits, one basket of fixed, you needed 22 units of your fixed deposit basket in 1990. Today, you need 73 of your fixed deposit basket to get the same consumption basket that you have. So that has really not kept pace. After taxes, it has increased by just 6% per annum. So overall, you are losing about 4% net being in fixed deposits. So FDs have been a losing proposition. Being in FDs has not helped you. You must have felt safe and secure with your money lying in fixed deposits. Many of us have seen even there are financial collapses where our money in fixed deposits have been lost or stuck for a time. But even post that, it has not kept pace in terms of meeting your standard, meeting the inflation increases every year. So that has clearly not been the place, though we have seen that a bulk of the money that India parks in terms of their investments is in fixed deposits. So more or less, many of us have lost big time because our money was in those fixed instruments and not things like gold or equities. So as we have seen, other options like equities, gold have been better. Should you just move money out of fixed deposit and go into that? Is that a wiser way to do it? Or is there a better way to do it? So let's look at the current scenario, right? Many of us are looking at equity markets, and on the other hand, our money in fixed deposits kind of losing money on a real basis. Many of us are thinking and contemplating whether we should move into equities. But if you look at equity markets at this time, we are seeing, after the COVID shock, we are seeing a good amount of rebound in the economy. Economic momentum is there. There was a cyclical recovery even before COVID, which after COVID has kind of kept pace, and it has moved further. And there has been a good earnings increase of corporates in India, which is helping this rally. So it's not just that the markets are running behind in terms of because of liquidity. To some extent, much of this rally has also been backed by earnings increases, which you see in the purple and the green line at the top on the right-hand side, which we are seeing a good sharp increase in earnings. And that is why what is helping equity markets move up further. But are markets now pricing in much of this earnings increase? To some extent, yes. Historically speaking, markets are trading at significantly higher valuations, and even incorporating that earnings increase that we will see, much of that looks like baked in the market. There could be some, because of the liquidity, because of low interest rates, there could be some momentum which kind of lasts. But overall, from a valuation perspective, equities do look expensive at this juncture. And what is helping is clearly there is a good amount of flows from foreign investors, from local investors alike. In 2021, we have seen $6.8 being pumped in by foreign investors and about $0.6 billion by local investors. So we are seeing that good increase in investments from investors, be it foreign or domestic, and that is because of the liquidity being sloshing around, no options for investors, and it has become kind of a self-fulfilling prophecy where every day we are seeing markets inch up to a new high. That is driving investors, but it's not certainly a time to go full in because markets are really expensive in terms of equity valuations. Coming to fixed income, again, we have seen that yields are moving higher. We have seen a small uptick after more or less the levels in the historically that we have seen yields bottom. Even currently at current level, at those levels, near about those levels, we have seen markets taking a U-turn and yields have started moving higher, right? There are risks in terms of government borrowings that have jumped significantly higher. If revenues don't keep pace, then these borrowings will lead to further increase, will be further increased because of that, and may lead to pressure on yields, and yields could move up further higher. What has been helping markets is RBI. There is commitment by the RBI to support growth. And therefore, in order to support growth, like central banks across the globe, we are seeing the Indian central bank as well, trying to put a lid or a ceiling on interest rate increases. And their bond buying program is certainly not allowing yields to move up sharply higher. Given the kind of borrowing that we have, if central bank was not there, yields could have been much higher than what they are today. So certainly the central bank action has been helping. Their buying has been helping to keep yields under control. One thing that is kind of pressuring even the RBI is rising inflation. Inflation has certainly moved up, and that's not only true for India, but across the globe. We have seen commodity price increases to multi-year highs, and that is leading to inflation. Given the trillions of dollars being pumped in by the central banks, by the governments, and unlike the aftermath of the 2008 crisis, where it was only the central banks leading the action, this time around we have even the governments pitching in, doing a lot of fiscal stimulus along with the monetary stimulus from the central banks. And when that money moves into the system, will certainly generate some kind of inflation out there. So that is what we are seeing, and therefore the inflation could be more structural, more sticky this time around, as opposed to what we saw after the 2008 crisis, where they pumped in trillions of dollars, but that money kind of stayed in the financial circles, in the banking system, and therefore didn't go into the real economy. And that is why we didn't see inflation that time around. But this time, money has kind of seeped into the real economy because economy needed support. And that is why inflation could be there with us for some more time. Coming to gold, of course, there is pressure on yields. Equity markets look expensive. Gold is one asset which kind of currently looks a bit fairly valued or slightly undervalued. Look at the money supply line. If gold is a form of money, is a monetary asset, then it should keep pace with the increase in money supply. So money supply increases is the red line, which is kind of a little higher than where the gold prices are, and which kind of makes gold slightly undervalued by this metric, right? If you see over the long term, they have kind of kept pace. Sometimes gold kind of overshoots, and sometimes during correction phases kind of undershoots, but more or less it has held the trend along with the money supply increases. Given that, the sharp correction that we saw recently was because of good economic data in the US, given the amount of money that has been pumped in, there will be bouts of economic growth. But the question is whether that growth will sustain or not. That is what will decide whether the Fed stance that they have changed is kind of persisting, or is just kind of because inflation is moving higher, they were compelled to showcase that they are not sitting ducks. they are kind of trying to do something about it. And therefore, they kind of signal that rates will be increased in 2023. Even that's 2 years out from here. So we don't know how things will pan out in these 2 years, whether they will be able to increase rates, will they be able to normalize policy or not? Will they be able to taper? Last time they started tapering, in 1 year's time, they had to abandon tapering. So that really didn't work for them really last time. And even if that happens this time around, then I think people will see that the normalcy that the central banks are talking about is not working at all, and which could lead to a big trigger for gold prices. So we will see how the policy normalization being talked about, and which is creating a pressure on gold, will be able to keep up pace going forward or not. But the fundamentals of gold are still very, very supportive. We are still seeing support from central banks, from governments. We are US just around the 1 trillion infrastructure spending. They are also contemplating another stimulus of 2.5 to $3 trillion. So with all this money created, there will be increase in money supply, which will again be better for gold, be supportive of gold. Another factor that drives gold is real interest rates. Real interest rates is nothing but interest rates minus inflation. Today, we have seen interest rates are low, inflation is surging higher. That could persist for some more time. And with whenever we are seeing negative or low real interest rates, gold does well. So it wouldn't be different this time. Gold should do well, and this is also a factor that should support gold. US has been at the forefront of stimulus measures. That will certainly weaken the dollar. Even if you look at US government's own projections of deficits going forward, up till 2030, each year they will have a minimum deficit of $1 trillion. So if the economic growth doesn't keep pace, the deficit will kind of widen further. And with all that debt and deficits out there, it will certainly put pressure on the dollar, and dollar should weaken. And if dollar weakens, we have seen that gold does well. So although from a fundamentals perspective, things look better for gold, currently, given the optimism, given the investors chasing risk assets and risk assets doing well, until that time, gold may remain range bound. But when these triggers start to materialize, gold may start doing well. So what's your pick today? Equities, fixed income, or gold? How do you pick the winning asset class? And I would say it is extremely difficult. Each year, we have seen the top position being occupied by either Sensex, either gold, or either bonds. And any year, it is very, very difficult to predict. You don't know where the uncertainty will come from. No one could predict COVID. There are so many episodes that were not being able to, no one was able to predict. And therefore, it is a futile exercise to try and predict which asset class is kind of likely to do well going forward. Each asset is there for a purpose. Equities are for that long-term growth. We saw that it has done extremely well over the long term, but it is also extremely volatile at the same time, right? Any given point in time, it could fall by 40, 50%. You don't know what kind of risk will hit, and it will kind of collapse. Like because of COVID, markets fell by more than 40% in just 1 month. After the 2008 crisis, the market fell by more than 55% in a span of few months. So you don't know where that trigger is going to come, and it kind of swings significantly. There will be a bull phase, a bear phase, and mini bulls and bear phases, which kind of leads to that volatility in equity markets. So that is very, very difficult to digest because, I mean, if you have full of your money in equities, it kind of collapses by 40, 50%. It becomes very, very difficult to digest, right? And fixed income is there for regular income and stability, and gold is there as a diversification tool. We have seen time and again when equities are not doing well, gold kind of helps you during that time. It's like the second engine of your airplane. If equity kind of shuts, gold is that engine will keep your plane moving at those times. So overall, if you look at from 2004 till now, equities have been the highest return generating asset with a return of 12.8%, right? Gold has given 11.5% and debt has given 7%. So if you look at the risk in these asset classes, also kind of proportionate to the returns that they have generated, which tells us that risk and return go hand in hand, right? And if you had a portfolio which kind of is, say, 40 equities, 40 debt, and 20 gold, has done 11.1%, which is slightly lower than what equities have done at 12.8, about 1.5% kind of returns lower than equities. But at the same time, look at the risk, right? Equities have a volatility of 22%. They kind of swing 22% at any given point in time, whereas the portfolio would have moved by just about 9.4%. The maximum drawdown, drawdown is something from the peak to the bottom, how much the fall is. If you measure, the biggest fall in equities has been 56%, whereas the biggest fall in a diversified portfolio is just 21%. So having a holistic approach in terms of 3 asset classes has done much better, slightly lower returns, but significantly lower risk. So that is the way you could move forward, because over the long run, you will still make decent return, but at the same time, you will not sleep, you will not lose sleep, and the returns risk will be substantially lower in that. So coming to hybrid funds, I know many of you kind of compensate for the low return in fixed deposits. You try to move towards hybrid funds, saying that hybrid funds are kind of asset allocation products. They kind of diversify across asset classes, and therefore they will give me decent returns, but at the same time give me lower risk. So that's the perception. But what is the reality? What is the reality in terms of how do hybrid funds do behave? Because even if you look at that space is now very, very cluttered, right? Within hybrid funds, you have various different categories, and each category does a thing of its own, right? So look at the types of hybrid funds, right? You have aggressive hybrid, balanced hybrid, conservative hybrid, you have dynamic asset allocation, and you have multi-asset allocation funds. Multi-asset are funds that invest in all 3 asset classes, whereas the rest of the others invest only in equity and debt. And if you look at aggressive hybrids overall and balanced hybrids, they are kind of biased towards equities. Even the dynamic asset allocation products that you have are kind of biased towards equities. When they are biased towards equities, they're trying to do 2 things. One is to generate better returns, because equities, as we have seen, has given better returns. And second is because if you are 65% minimum equities, you become taxed like equities, which is kind of over the short run is more efficient, right? So while trying to achieve those 2 objectives, invariably these funds end up taking much higher risk, because equities, the higher the allocation to equities, the higher is the risk, right? So if these funds are ignoring gold, right? The top 4 categories are ignoring gold. We think that shouldn't be the case. You should have an allocation to gold. And the table on the right hand side shows you why you should have an allocation to gold. Like equity plus debt and equity plus debt plus gold has more or less similar returns. But look at the risk, right? Equity plus debt portfolio has a standard deviation volatility of 13.5%, whereas the 3 asset portfolio has 9.5%. And look at the drawdown. The equity plus debt portfolio has fallen by 36%, the biggest fall that it has seen. Whereas if you include gold, your decline, the drawdown falls from 36% to 21%. So it does merit to have an allocation to gold, and therefore the 4 categories that you have above, not only they are biased towards equities and therefore higher risk, ignoring gold is again a misstep, and we think that it should be part of the portfolio. So multi-asset funds are a better allocation if you're looking to a hybrid portfolio, as opposed to the top 4 aggressive hybrid and balanced hybrid categories. If you look at the aggressive hybrid, we have just taken a crystal index of 35-65, 65 equities, 35 debt. And on the other side, we have BSE Sensex, BSE 30 TRI. If you look at the statistics, the Sensex has generated 14% returns, and the CRISIL index has generated 12% return. This is in 2007 data. If you look at the worst year, the Sensex fell by 58% and this fell by 14%. And the number of years, this is based on rolling data. So overall, 23% of the time or years on a rolling basis, Sensex has given negative returns, whereas the hybrid has given 17%. So invariably, you were taking a much higher risk even with hybrid and very close to what pure equities are, rather than trying to be invested in something which reduces risk substantially. So the question to investors who are in these aggressive hybrids, you are invariably taking similar risks, and why not be in pure equities as opposed to being hybrid funds? They don't kind of save much. There is very little protection in terms of downside protection that these funds bring to the table because they are biased towards equities. So being in aggressive hybrids is very close to being in pure equities overall. This is kind of a fantastic chart to show you how things have behaved. Each period or each point is firstly a bull market, then a bear market, then a bull market, then a bear market. It's kind of the different phases of the markets that they have seen. So if you look at the upticks, they are the bull markets. The downticks are the bear markets. So if you look at the yellow line is the large cap funds. The red line is balance advantage. The light blue line is aggressive hybrids. And the green line is the multi-asset allocation. If you look at historically, the multi-asset as a category used to not give you returns which are significantly as high as the equity kind of assets will give you during a bull market. And when markets fell, they wouldn't fall much. So they would give you a steady kind of returns, limiting downsides and upsides also, they will give you reasonably good returns, right? But if you look at the recent time frames where, post the SEBI recategorization, the multi-asset allocation funds look very close to the equity kind of funds, which means that they have taken or they have moved or shifted their allocations to be more biased towards equities. Why? Because they also want to kind of portray to you that they also are tax efficient, they also are high return generating assets, and therefore to get a pie of your wallet, right? But that shouldn't be, because people are moving into multi-asset funds because they think that they will give us reasonable returns. At the same time, they will try and minimize the downside risk whenever it occurs. So it used to do it till 2016, but post 2017, 2018, when the reclassification happened, these multi-asset funds kind of changed course and kind of have become biased towards equities. Whereas if you see the aggressive hybrid, balanced hybrids have been very close to what large caps have delivered. So therefore, the question that you are invariably taking the same risk, you're going up like equities, you're falling like equities, why you should be in those funds if your objective is to kind of get reasonable returns over the long time frames and at the same time minimize the downside risk whenever the market falls. So these categories haven't been able to do that if your objective was that. And even now, multi-asset funds seem to be changing course and moving into that direction, which is not what really investors want. If you're looking for an alternative to FDs, then I don't think that these funds kind of fit the bill. Only multi-asset funds, which are kind of still the multi-asset types that you used to know, who have not changed course, are the ones that you could still consider, right? This is what I was talking about. This is the equity allocation in each fund, in multi-asset funds benchmark. Benchmark is a representative of the fund, and therefore, whatever the benchmark allocations are, fund will deviate around those benchmarks. So if you look at the multi-asset category on an average, have about 60% allocation to equities in their benchmarks. Maximum, many funds have about 65, 70%. and the minimum is 40%, which is quantum multi-asset fund is also at 40%. So the range that we have for our equity allocation is between 25 to 65, and our benchmark has a 40% allocation. So you have to choose what is your objective, whether you want to be in funds that tend to give you reasonable returns and at the same time endeavor to minimize your downsides, or you want those aggressive funds. And I will say, if you're choosing those aggressive funds, you better be in equity funds rather than being in hybrid funds. And if you want to be in hybrid funds and you're looking as an alternative to fixed deposit, you have to consider funds which have lower allocation to equities. Only then those funds will be able to protect your downsides. So according to us, asset allocation should be unbiased, should be dynamic, should be agile, should not be biased to equities like many of the aggressive hybrids are or many of the multi-assets are. Should be dynamic so that they kind of capture the opportunities whenever they arrive. I'll show you an example on this dynamic allocation. And they have to be agile. They cannot have rigid frameworks. They need to move very fast in and out so that they kind of capture the opportunities and minimize the risk whenever it warrants. So if you look at the multi-asset fund, the way we have designed it is equity is 25-65, debt is 25-65, gold being a diversification tool is 10 and 20. So we are not biased towards either equities or debt. Depending on the market scenario, depending on valuations, wherever it warrants, wherever there are opportunities, we will try to capture those opportunities, and wherever there are risks, we will try to minimize those risks. So that has been the approach, and this non-biased approach or framework helps us to do that. So if you look at the current market scenario where equities are expensive, we are at the lower bound of our equity allocation. We are at about 26% equities. Our range is 25 to 65. So we are at the lower bound, keeping in mind the risk that persists in equity markets because of high valuation it trades at. Debt is 56% of the portfolio, and in debt, out of that 56%, 42% is in liquid fund. This because of rising yields, the liquid fund will not get impacted as much, and therefore that is our allocation today. Gold is close to 15% of our allocation, so our range is 10 and 20%. But in our framework, we will go 10 to 15%, and we will let market returns be the rest of the 5%. So even in gold, based on the internal framework, we are at the maximum because gold looks undervalued today as compared to other asset classes like equities and debt. So that has been our approach. And if you look at within the asset classes, also we are diversified. In equities, we have the value fund, we have the ESG fund, and we have the Nifty ETF. Even in debt, we have liquid fund and dynamic bond fund as diversification. And gold, we have quantum code ETF. So as I was talking about the agility in the allocation process, that is a must. For example, before COVID, we were at close to 25% allocation to equities, 25 to 27% in that range, because even then markets were running expensive. As markets fell because of the COVID shock, it really made equities reasonably priced, and we kind of increased our allocation significantly from 25, 26% to 50%. And then as markets run up further, we kind of have gradually lowered our allocation. And we have been holding that lower allocation for some time now, waiting for an opportunity, given markets are running expensive and doesn't make sense to risk investors' money if there were a correction in markets. But if there is correction and if there is an opportunity, we will certainly increase our allocation. So we have kind of increase and decrease, not shy of taking that broad calls through our investment and research process, which is very research oriented, and drive our allocations. So we will certainly not shy when there is an opportunity, but when there is a risk, we will refrain from taking that risk. So if your objective, as we started, is to beat fixed deposits, at the same time, you will end up taking slightly higher risks than fixed deposits. but at the same time, you will earn better returns than your fixed deposits. If you look at the quantum multi-asset fund, 90% of the time, this is considering each day, 90% of the time you would have been better in the quantum multi-asset fund. And if you look at standing today over the long time frame, the differential has increased over time, and you would be better in the multi-asset fund as opposed to being in a fixed deposit. And when I said you end up taking slightly higher risk, if volatility is measure of some measure of risk, you have taken about the standard deviation of volatility is just 6%, which is significantly lower as compared to likes of equities, which is 15, 20, 22% kind of volatility. So you have not taken much risk, but at the same time, you have earned better returns. The annualized return has been around 9.6%, which is much better than what your FDs give you. So even on a rolling basis, each year is a 3-year return. Each point on the graph is a 3-year return. And on a 3-year return, it has given you better returns about 86% of the time being in the multi-asset fund as opposed to being in fixed deposits. So it has certainly helped you, and 3-year number is better, is meaningful, because after 3 years, the multi-asset fund becomes more tax efficient. FDs will be taxed no matter your duration based on your tax bracket, whereas multi-asset fund after 3 years is taxed at 20% with indexation, and your tax will end up, depending on the indexation benefits, between 8 to 12%. So that's much lower tax and much better returns than your fixed deposits. So if you look at the returns from the multi-asset fund, it's been around 8.6 to 9.6, depending on the time frame that you're seeing. So it's very, very consistent, very, very steady. It's not very, very volatile like we have seen. The volatility is just about 6%. And across time frames, it has given you that broad return that you're looking for, beating the fixed deposits. And one more characteristics is, over a 3-year period, if you're looking at 3-year rolling returns, there is no 3-year period where it has given a negative return. So it has kind of managed in a manner that it has not seen a negative return over a 3-year basis. And the maximum return that it has seen on a 3-year period is close to 13.6%, and average return is around 8.8%. So this is how the different assets have behaved. Right on the top is equities. Equities, because of the run-up that we have seen recently, is significantly higher than other asset classes. The next, if you look at the blue line, the light blue one, is the multi-asset fund, and the dark blue is a liquid fund. So you end up getting better returns than most other asset classes as other than equities. And then this is how different asset classes have behaved. If you look at equities, have been significantly volatile, whereas debt and gold are not that volatile. And even the multi-asset fund has kind of reduced volatility, but given you better returns. And more importantly, like the slide that I've showed you, if you look at since 2016, 2017, many of the multi-asset funds have changed course. They have kind of become more aggressive with their equity allocations, whereas multi-asset fund, the quantum multi-asset fund, has not really changed course. It has kind of kept its same bands of equities. It is not biased towards equities or any other asset class. And therefore, if you look at the bull market of 16 to 20, it did give you better, similar returns to the other multi-asset funds. In the downfall of COVID, it kind of restricted the fall as compared to other multi-asset funds, but other multi-asset funds, or the multi-asset as a category, was saw similar fall as compared to what aggressive hybrids saw, which are really biased towards equities. So the quantum multi-asset fund has kind of given you lower downsides. At the same time, in the rebound, it has not rebounded as much, which tells you it has been true to label. It has not changed course, and it will continue to do same. It will not rise as much during a significant bull market. At the same time, it will not fall as much when there is a sharp correction in equities. So overall, if you're looking for options to FDs, which you are kind of looking, if you're looking at market linked returns, if you are looking at lower volatility, better predictability, and lower downsides whenever there is a downside in equity markets, then I think the quantum multi-asset fund is the answer for you. So whenever you are moving in search for yields towards hybrid funds, toward asset allocation products, please do keep in mind they should be unbiased. If you have a very high allocation to equities, you are invariably taking the same risk or similar risk to what your equities give you, and therefore it will not protect the downsides. The lower risk that you are wanting to take, that will not materialize. In a bull market, it will all look good, but in a bear market, it will all fall down. So you look at a fund, because equity and debt alone is not enough. You need to have a three-pronged approach to have equity, debt, and gold, because gold is an essential part of the portfolio. So you should have an allocation to gold. It should diversify across all three, not dependent or not biased to any one particular asset class. It should have the flexibility to kind of, even if the fund manager doesn't like equity markets, they should be able to exercise that option and try to lower their equity allocation. If their mandate is minimum 65%, they will not be able to do that, and therefore you will take higher risk than what you're wanting to. Multi-asset funds are tax efficient than your fixed deposits, and therefore I think it is a much better way to shift from your fixed deposits, which is a losing proposition, to something that will get you better returns with lower volatility or lower risk. I mean, higher risk than your fixed deposits, but lower than many of the asset classes out there. So I think this is a reasonably good option that you have. It is something that you can focus on and take the right decision. Just don't focus on returns. Look at also elements like risk, cost, time, and how it will behave. What is the predictability? And take that call. So next time you book your fixed deposit, please understand that you are doing going into a losing proposition. You need to move out of that. Don't take very high risk with equities if that doesn't warrant to. If you want to keep your money reasonably safe but still earn a higher return, then multi-asset funds, which are not biased, like the quantum multi-asset fund, is the answer for you. So look at diversifying across all three asset classes, and just make sure that you are not taking a wrong fund within your ambit. Understand the risk return proposition, and then only invest in those funds. So with that, I hope that next time you book your FDs, you will take that informed decision in terms of where you are parking your money. FDs, again, please remember, has been a losing proposition, will continue to remain, at least in times when inflation is surging higher. And so it does warrant to move an asset-pronged approach, diversification approach, where you have a higher probability of getting a better return. So with that, thank you so much. And I will hand over to Vipin, and will be happy to answer any questions you have.
Thank you, Chirag, for that insightful presentation. Now we will begin the Q&A session. I request all participants who have any questions to please send them in through the chat box. So Chirag, the first question that we have received is, bank FDs have no disclaimers as opposed to mutual funds. How can an investor in such a case address the safety when it comes to investments with mutual funds?
So firstly, when you're looking at safety, you have to look at whether what is the downside. Is there any instrument, or is there any holding within that mutual fund which is likely to go bust or not, right? There have been instances where people have lost money in, say, credit funds, for example, which kind of is a risky proposition. But people thought that they cannot give negative returns, they cannot lose money, but it has turned out to be true. So if we have carefully crafted instruments within the quantum multi-asset fund, so that the downside risk or the risk of a blow up is not non-existent. For example, even if we have a small exposure to dynamic bond fund, because we know that dynamic bond fund doesn't invest in credit papers, it doesn't do private credit, it does only invest in government securities, and PSU, AAA PSU kind of papers. So we know the kind of the papers that they will end up owning, and therefore the downside risk isn't existing. And so we kind of have an allocation to that. So one has to understand what is the holding of that mutual fund, and whether there is a downside risk in terms of blow up. Even in banks, right? People think that bank FDs are kind of completely secure. They don't have any downside risk, or they don't have any risk of losing money. But we have seen so many instances over history that the banks have gone bust and people have lost money. So within it is a fair question. Within the mutual fund, people have to understand what kind of holding that the fund manager will end up owning, and whether any of those holdings have that blow up risk or not. So within the equity basket also, the holdings are diversified across three funds, and all of those funds are very well diversified. So any one, the risk of any one entity going bust the risk of that is severely minimized given the diversification that we own. You cannot rule out, and therefore diversification is the best bet that you have. So two things: one, investors have to understand what is the liquidity of the underlying holdings, and whether there is the risk of that blow up or not. If you understand those two things from the fund managers or from the documents by the fund houses, and if you're convinced, then only you should invest. So there will be enough disclosures or disclaimers from the fund houses, but it is up to you to understand where you're parking your hard-earned money, and whether these risk of liquidity, whether risk of blow up exist within the portfolios that the fund managers create.
Thanks, Chirag. The next question is, if not FD, can alternatively investors put their money, or invest their money rather, in liquid funds?
Certainly, liquid funds. Again, we have seen there were many liquid funds also who took higher risk and have investors have lost money there because they were also kind of moving into credit or private company lending. And therefore, there were investors who lost even in liquid funds because their NAVs fell because of the losses that they had to bear. So even in liquid funds, the same thing will be applicable. You look at holdings, whether there is a risk taken by the fund manager to get you that small higher return or not. Liquid funds are meant to kind of park surplus money rather than keeping in saving fund accounts. You kind of move into the liquid fund and try to earn a slightly higher return. But when you're trying to do that, one should not look at a liquid fund that is trying to generate even slightly higher return than most liquid funds would do, but invariably end up taking much higher risk. So quantum liquid fund, for example, does not invest in any private papers or private companies. They will only invest in government T-bills largely, or AAA PSU kind of companies, CPCDs of those kind of entities. They will not invest in any private entity credit. So that really tells you that kind of liquid fund is better as opposed to one that takes risk, because you are trying to just be prudent with your parking of money rather than earning that higher spread, which comes at a risk. So overall, one has to look at liquid funds again. So if your objective is to parking surplus money, then you can go into liquid funds. But if your objective is to beat fixed deposits, then that won't, at most times, not be possible with liquid funds. And to move into market-linked asset allocation products that do not take overt risk, but try to generate you better returns through a diversified portfolio is the approach that you could have.
Thanks, Chirag. The next question is, what is the difference between conservative hybrid funds and multi-asset funds from the risk-reward point of view?
Sure. So conservative hybrid funds are funds that are biased towards debt as an asset class. So they will have very limited exposure to equities. They will have not more than 25%, or their equity exposure will be capped at 25%. Whereas see here is a table which tells you, so equity allocation will be somewhere between 10 and 25%. They will be biased towards debt. They will have 75 to 90% allocation to equities. Whereas multi-asset allocation will have minimum 10% in each asset class. So equities can be anywhere between 10 and 80%. Debt can be somewhere between 10 and 80%, and gold also can be between 10 and 80%. So that's the mandate or the framework built by the regulator. And that is where each fund will carve out their own. So certain multi-asset funds will have a minimum 65% allocation to equities, and debt and gold will be a smaller portion of their pie. Whereas what we have done is equities are 25-65%, debt is 25-65%, and gold is 10 and 20%. So that's the broad range, which kind of, if we don't like the equity market valuation, and if it is a significant risk out there because of high valuation, we will refrain from taking that risk and be at, say, 25% allocation to equities, which is significantly lower. Whereas a fund manager which has a minimum 65% allocation to equities, even if they don't like the equity markets, if they think it is a significantly higher risk, will not be able to lower it than the 65% mandate that they have. So, so that is the broad difference that investors need to keep in mind. Conservative hybrids will be biased towards debt, whereas multi-asset funds will be either balanced or flexible, or there are many multi-asset funds which are biased towards equities. So that's the broad difference between the three.
Thanks, Chirag. The next question comes in the form of understanding. How does allocation to gold help in quantum multi-asset fund of funds?
Yeah, so time and again, we have seen that, gold is a very good diversifier. Even in times of COVID market crashed, gold was holding steady and then increased significantly. With the euphoria that we have seen now, gold has kind of had a setback and equities are doing well. So gold, time and again, we have seen that when equities are kind of correcting or falling, gold does hold well and increases in value. So even during 2008 crisis, when markets fell by 56% or more than 50% in that 2008 year, gold was up 30% in that year. Even during COVID, when markets fell last year, gold was the best asset class amongst the three. So overall, we have seen that gold holds well when there is risk out there. So it is extremely helpful. And over time, we have seen there was a slide that we showcased where gold has really helped as compared to a portfolio of equity and debt. So equity plus debt portfolio and equity plus debt plus gold portfolio has similar returns, but look at the risk. The standard deviation falls from 13.5% to 9.5%. The biggest fall, the drawdown, the fall from top to bottom is 36% in an equity debt portfolio. There is just 21% in equity debt gold portfolio. So gold doesn't minimize return, doesn't compromise on returns, but it does lower risk substantially. So that really helps you. So whenever there is a crisis or whenever there is a decline in equity markets, we have seen gold helps. And therefore, we think an allocation to gold is imperative in a portfolio.
Thanks. The next question is asking, when was Quantum Multi-Asset Fund of Funds launched and what is the track record of the fund?
Sure. The Quantum Multi-Asset Fund was launched in 2012, in July 2012. And the track record is here. Since inception, it has given 9.63% return. And if you look at any long time frames, since inception, that is in 2012, about 9 years, 7 years, 5 years, it's very, very consistent. It has given 9.6 to 8.6% kind of returns over time frames. So this is a broad track record of the fund.
Chirag, the next question is, can hybrid funds support SWP?
So any fund can support a SWP, right? SWP is an investor option to exercise. If you need money at regular intervals, you can opt for SWP. So it could be used in any mandate, be it an equity fund, be it a hybrid fund, be it a debt fund. So it can be used. You're kind of taking your money back instead of you doing a regular redemption. You're using a automatic mandate to get you that money at regular intervals. So SWP can be done in any kind of vehicle. It depends on your needs. If you have that need, you could do it even in a hybrid fund.
Sure. The next question is about how often will rebalance happen in quantum multi-asset fund of funds?
So we do tend to rebalance or look at portfolios regularly. It's not necessary that we take actions. So if you look at this allocation, time and again, we kind of keep monitoring or looking at our model allocations and looking at our research processes very regularly, almost on a daily basis. It's not necessary that we take an action. Whenever there is a need for action, for example, in that month of March 2020 alone, when markets fell by 40%, in that 1 month alone, we kind of gradually increase our allocation from 25% to 50%. So we kind of rapidly change in that 1 month course, and there could be months when we don't even touch the allocations that we have, if it is unwarranted. So we kind of monitor it regularly. We kind of rebalance it because we keep getting inflows, outflows. We keep looking at market valuations. So basis that we kind of rebalance. Even the flows kind of help us rebalance to an extent. So rebalance is not a set metric because there are inflows and outflows that kind of help us move towards an optimal allocation. If not, but then we will kind of do it at least every year or every 6 months.
Thanks, Chirag. This next question could be a little generic, but if you could want to touch upon one or two of these points. The question is, what is the role of ratio while selecting any scheme, and how to read and what is the meaning of all ratios? So would you want to touch upon a couple of these? I understand this is very generic.
Yeah, so most of the ratios are an indication of risk-adjusted returns, right? So returns are just one element. The ratios help to analyze what is the risk taken by the fund manager to get that return, right? And some ratio that is kind of a Sharpe ratio. There are something like information ratio, which kind of tells you what is the excess return generated by the fund manager over the benchmark that he's trying to beat, and what is the risk taken by the fund manager to get that excess return. So that's an information ratio. So all these ratios usually are a metric of risk-adjusted returns in some shape or form. They will either tell you in the upside when the markets move, what is the risk-adjusted return that the fund manager had. Whenever the markets were falling, what is the risk-adjusted return that the fund had. So it kind of helps you to kind of dissect the performance and help you to know what is the true value add by the fund manager. If someone takes a higher risk to get a higher return, then that's no use because you have taken that higher risk to get that higher return. But if you have taken got a better return and taken lower risk, then that is something that is meaningful for you, and you know that really is helpful because the risk is lower and returns are higher. So that is the value addition that ratios bring to the table, get you the perspective of the other side of looking at returns in light of the risk that the fund has taken.
Sure. Chirag, the next question, the investor wants to ask whether should he or she do a lump sum investment at today's market levels in quantum multi-asset fund of funds.
So in a multi-asset fund, I think you are relying on the fund manager to kind of navigate markets, right? So even if there is a fall in equity markets, we are running at the lowest allocation as per the mandate that we have. And if there is a correction and if there is a good opportunity in terms of market moving lower, and it helps us increase the allocation during those times, we will do that. So you are kind of relying on the fund manager to do that. So if you are an investor who does a lump sum FD, here is a similar thing that you could do a lump sum multi-asset and rely on the fund manager to help you navigate markets. If it is expensive, and not take that risk. If there is an opportunity to grab it with both hands. I think even in today's market, see, if you have an equity allocation of say 25%, and even if markets fall by 20%, the fall that will bring to the table is about 5%, right? There are other asset classes like debt and gold, which likely will compensate during those times. So your fall in totality could be lower than that. So you have to look at it. Am I willing to take that risk today or not? And if you are, and if you can rely on the fund manager to navigate the markets for you, so that if there is an opportunity to capitalize on that opportunity for you, then I think lump sum is what is desirable or would be recommended. And in a multi-asset kind of framework where there is a flexibility to the fund manager is kind of refraining from taking over risk, then in those kind of funds you could go in a lump sum. I don't think in a multi-asset fund a staggered investment does make a lot of sense, because there is a fund manager trying to be on top of markets and trying to ensure you get an optimal risk-adjusted return.
Thanks, Chirag. In the next question, the investor, or rather the participant, wants to understand, will quantum multi-asset fund of fund also invest in quantum equity fund of funds?
Yeah, I would love to. As a fund manager, I would love to invest in the quantum equity fund of fund. But as far as the regulations go, a fund of fund cannot invest in another fund of funds. And to compensate that, we also have an allocation to Nifty ETF. So we don't end up taking too much style risk, because equity fund of fund will help us diversify across styles and give us that broad diversification. And when we are left with options like the Nifty ETF, like the quantum long-term equity value fund, the quantum ESG fund, to not take a particular style risk, we do have a large allocation to Nifty ETF as well. So that is how we have designed it. But if regulations were to permit, I would love to invest in the quantum equity fund of fund as well, in the multi-asset fund.
Sure. So the next question could be a little interesting. The participant observation, and he feels that the data suggests that an index fund may be better. He's asking whether is he right or wrong?
So the belief is that in India, markets are still not that efficient, right? And therefore, there is scope for, alpha creation by the active fund manager. So, but we are not willing to take a very high risk in terms of taking a style risk. So if you look at our equity allocation bucket, we do have a very large allocation to the Nifty. And it's not because we don't believe in active management. We still think there is a big scope out there. But this is an asset allocation product where we don't want to end up taking a very high style risk. So for example, there could be times when, say, equities are expensive. We have a lower allocation. And within that, if we have a very high allocation to, say, a value style, and value style is not doing well, we don't want to have a double whammy for investors. And therefore, over time, you will see a significant portion of our equity basket will be in the Nifty ETF as opposed to be in the active styles of value and ESG that we have. So ESG, if you look at, is just about around 10% of our equity valuation. Over a period of time, I think the way we are kind of constructing it, over time, that Nifty ETF will be the bulk of our equity allocations, and the active managements will be lower. And that's not because we don't believe in active. We believe that over style risk will be not good for an asset allocation product, and therefore we will tune our portfolio to that.
So next one is a very targeted question. The participant is asking if quantum multi-asset fund of fund is suitable for retirees.
So even for retirees, there are various nuances, whether you are dependent on the income from this. Is this for kind of wealth maximization, passing on to next generation? What is the objective that is there? So if it is for any time frame which is less than 3 years, then I would not suggest that you look at the quantum multi-asset fund for retirees. But if your horizon is more than 3 years, then you could look at the quantum multi-asset fund. But again, it will depend on what kind of objective that you have. That will determine whether you should be in a quantum multi-asset fund or not. If you are looking for a regular monthly income, then this may not be a product. Anything that you're looking to utilize after 3 years or more, then this could be a product for you.
Does it make sense to switch holdings from quantum gold savings fund to quantum multi-asset fund of fund? And there is an additional question to this. It says, gold seems to be going into a medium, if not long-term decline, and maybe only a part of the holding should be in gold, which quantum multi-asset fund of fund offers.
So it will all depend on, see, what we recommend is gold to be 10 to 15% of your portfolio, right? So it will depend on whether if you just have, say, quantum multi-asset fund as your holding, if your entire holding, apart from your emergency corpuses and your fixed deposits, then probably, you could not have any other gold exposure. But if you are having a multi-asset fund as a small portion of your allocation, then you need to have an allocation to gold. For example, other than your emergency corpus that you have, you could look at an allocation of 80-20, 80 to equities, 20 to gold on a generic basis. That is what we have seen has worked well for investors. And therefore, that could be one strategy that you have. But gold is something we don't think is in a decline, because the policies that we pursued by central banks across the globe are kind of kicking the can down the road policies. They are kind of shifting the day of reckoning. They are trying to paper over any problems that come their way, be it any crisis, be it problems of any other economic problems. They are kind of printing money, keeping rates low. So I don't think that gold is not a good asset to own. Gold is an excellent asset to own. Rather, what one should do is invest in gold and pray hard it falls by 50% the very next day. If that happens, then your other 85% that you have in other assets will likely be doing well, and therefore you would not want to see what your gold is doing. But if your 85% is not doing well, you better have that 15%, because those are times when you will really want gold in your portfolio. So we still do believe that there are various risks out there. The debt levels in the world have gone to alarming levels. The deficits are rising each year when we'll be converted to debt going forward. There are various geopolitical hotspots. The uncertainties out there are significantly larger, and that does warrant an allocation to gold. So we still believe that one should have an allocation of 10 to 15% of their overall portfolio to gold. And if it is not, then you should build over and above what the quantum multi-asset fund offers you.
The next question is to understand what is the current ratio of equity, debt, and gold in quantum multi-asset fund of funds.
Sure. So we did run through those numbers. Currently, we have about 26% allocation to equities. We have about 54% allocation to debt, and about 15% allocation to gold.
Chirag, the next question is, why is quantum multi-asset fund of fund biased towards quantum liquid fund as compared to quantum dynamic bond fund? Should it not be the other way around?
Sure. If you look at the dynamic bond fund, many times there could be similar reasons for the yields moving up and equity markets falling. So you are not diversifying your exposure out there, whereas a liquid fund is much safer. The risk of capital loss is very low in a liquid fund, whereas in a dynamic bond fund, it could be substantially higher. Like the yields have been moving higher right now, it is not conducive to have a large portion in the dynamic bond fund because you end up getting that capital losses along with your returns. So there could be, I mean, yields are up on the increase right now, and therefore dynamic bond fund itself in the current market scenario should be a lower allocation. Even otherwise, there could be same triggers for the yields moving up and equity markets collapsing, and doesn't offer you diversify. So whenever we will have a debt exposure within the multi-asset fund, it will be biased towards liquid funds rather than being on a dynamic bond fund. We want to capture because there is still a risk. Any given point in time, yields could substantially rise, and that could bring losses. And we don't want that kind of diversification. So we are parked more on the safer end of the spectrum in the liquid fund as opposed to the riskier end of the spectrum, which is a dynamic bond
fund. The next question is to understand, is there a minimum lock-in period? And what is the total expense ratio and exit load for quantum multi-asset fund of fund?
Yeah. So many investors fear that, given that it is a fund of fund, there will be dual expenses and dual fees paid by them. To clarify that, quantum multi-asset fund doesn't charge any management fees for managing this fund. It is only the scheme running expenses that are there, which are charged, which is 0.1%. But that is not only what investors end up paying. Investors also end up paying what are the expense ratios of the underlying funds. So today, if you invest in the quantum multi-asset fund, 0.1% of the multi-asset fund plus that of the underlying funds totals to 0.58%. So total an investor true cost of investing in the quantum multi-asset fund of fund is around 0.58% today, and it could deviate by 0.1 to 0.15% depending on what kind of exposure we have. And on the lock-in period, there are no lock-in periods. Up to 3 months only, there is an exit load, and beyond 3 months, there is no exit load on the fund.
The next question is from a participant who would like to understand what time frame is better when it comes to investing in quantum multi-asset fund of funds.
So I believe a time frame of 3 years is better. A minimum of 3 years is better to be in a multi-asset fund. Or 3 years or any 3-year period, we have not seen a negative return in the multi-asset fund. So the risk of getting a lower return or a negative return minimizes when you have a 3-year horizon, at least. After 3 years, it becomes more tax efficient, which is 20% with indexation. So overall, your tax comes to somewhere between 8 to 12%, depending on what the indexation is. Usually, we have seen it around the 10% mark, but the broad range is between 8 to 12% tax. So it becomes more tax efficient there. And at least over a 3-year period, if there is volatility in markets, it kind of gets evened out if you have at least a 3-year horizon. And therefore, that kind of historical performance that we have seen that over a 3-year period, there is no negative return is because of that volatility across asset markets gets evened out over at least a 3-year period. So we will recommend that if you have a minimum 3-year horizon, then you should be in the, it's not that your money you cannot withdraw before a 3-year, after 1 year, 2 years, whenever you want, you can withdraw your money if there is a need. But the efficiency kicks in largely after 3 years.
Sure. The next question is to ask if we have any comparative data against 5-year FDs.
against 5-year FDs, this is a long-term chart of fixed deposits versus the multi-asset fund. And if you look at this chart, which is each point on the graph is a 3-year return. So if you're looking at a 5-year time frame, it's generally a 5-year thing, and each point is a 3-year rolling return, right? So most of the time, if you look at the blue line, has been above the orange line, which is a 3-year rolling fixed deposit return. So 3-year rolling fixed deposit return have come down from 9% to around 6.5% now, 6.5 to 7% in that range. Whereas if you look at the multi-asset fund has a 3-year rolling return of about 14% at the highs and about close to 2% at the lows. So on an average, it has given about a rolling return of about 9% or so, and which is much better than your average return on your fixed deposits.
Sure. The next question is, can you please clarify if the gold rate shown in your comparison chart is international gold price or is it Indian prices?
No, generally we use an international gold price. The chart that we have shown is international gold prices. I mean, depending on, I hope the investor is talking about this chart, which is the international gold price. So international gold price, this is a rebased chart again, but the international gold prices are around that 1750 mark today. But given that this is rebased to 100 to see how the money supply has increased and how the gold prices have increased, to give that comparison here.
Sure. Chirag, the next question is from a participant who wants to understand what is your success rate of timing the asset class in this fund?
Sure. And just to clarify on the previous question, in this table, here we have the INR gold rates. The gold rates that 11.5% return on gold since 2004 till now is the INR gold rate return. So I mean, what we have done is how we have constructed is, you know, it is all process oriented. It is all research oriented work that we do. It's not that if I get up on the right hand side of the bed, I will have an equity allocation of 50%. If I go up on the right side, then it will be 20%. It is not dependent on what I feel. It is dependent on what the factors tell us. So the approach has been to minimize risk and to take opportunities only when the risk is lower. So, I mean, if you ask us why we were at a lower allocation before COVID, were we predicting the COVID? No, we were not predicting COVID. Only market valuations were higher at that point in time, which was not conducive to taking risk. And therefore, we were at the lowest allocation to equities at that point in time. In COVID, markets fell down. It gave us an opportunity. We grabbed it with both hands. In just 1 month alone, we increased from 25 to 50%. If markets were to correct further, we would have increased our allocation further because it was making all sense to be or increase allocation to equities. And that's what we did. So we don't kind of decide in a way what should be the allocation. It is what the research tells you. And there are various parameters that go into. We look at the valuation of as an asset class. We look at relative valuations. So that given that interest rates are today, many justify the equity valuation that are prevailing. But even adjusted for that, equity markets are still expensive today. So we kind of factor everything into what decisions we take. So there is a dashboard that throws us all the data. We analyze the data, then take the call. So it is all research backed, it is all data backed, and it is not dependent on what I feel. If our intuition is incorrect, we will double check the data and ensure that we are not missing anything. If we are missing anything, we'll try to incorporate that and take the right calls for you. But the approach has been trying to minimize risk whenever it doesn't warrant to, and grab opportunities if there is lower risk with that opportunity. So that is what we have been doing. And over time frame, I think we have been pretty successful at that. Not a single negative return over a 3-year period does tell you that we have been kind of successful in our endeavor.
Currently, both debt and gold are giving low returns. Is this fund going to manage the three asset classes dynamically?
Yes, we have been doing managing it dynamically. So as I said, each asset class is there for a purpose, right? And we don't kind of deviate or ignore the usefulness if an asset class is not performing at that point in time. So we didn't know COVID was coming in. Markets fell sharply. Gold helped us during that year, right? Markets are expensive. There could be a correction on the anvil any point in time. If there is any correction, I think gold allocation will be helpful during that time. So we don't deviate from the purpose that each asset class brings to the table, and we kind of utilize that as our premise to have an allocation. But we do manage each asset class dynamically, and even within asset class dynamically, to see if we are not missing out any good opportunities to be allocated to that asset class appropriately.
What are the rolling rate returns of this fund on a 1, 3, and 5-year basis?
So I don't have the 3-year return right now, but the chart that you saw as a comparison to FDs was a rolling return chart. So each point on that graph was a 3-year return. So this has been the 3-year rolling returns of the fund. And if you look at the statistics, the average rolling returns has been 8.8% on a 3-year basis. The maximum that it has seen on a 3-year basis, 13.6%, and minimum it has seen is 1.5%.
Thanks, sir. The next question is to understand whether small AUM is a drawback for this particular fund.
So AUM, I think that investors perceive it in a wrong way. Investors think that small AUM will not help the fund manager to strategize in the appropriate manner that he wants to. But it all depends on how the underlying that the fund invests into are liquid or not. If I have to put in 100 rupees or 1,000 crores in the underlying instruments, whether I will be able to do it with ease or not, that is what is material, and that is what shapes a fund manager's ability to kind of manage the fund well or not. If you look at the underlyings that the quantum multi-asset fund invests into are all very, very liquid, have significant depth, have significant AUMs, and have if those funds are smaller, the underlying that those fund invest into are very, very liquid, and therefore they can do it with ease in terms of managing inflows and outflows. So there is no hindrance to the current fund size, or even if the fund size increases to multi-thousand crores, even at those levels, we will not have any hindrance, because the underlyings that we have are significantly liquid. Investors need to understand that AUM is usually an hindrance when the size becomes larger, because the fund manager will not have enough opportunities to deploy that capital, and therefore each fund has a capacity to the way they are managing today. At that capacity also, they should be able to manage it in the same way or not, and therefore there is a higher side capacity which is more important than the smaller fund size becoming an hindrance. So so one has to consider, if you look at many of the mid-cap funds, for example, in the country, have become so significant high in size that managing at those sizes becomes really difficult. So usually a small size is not a hindrance. A larger size becomes a constraint. So for us, with regards to the multi-asset fund, this size is not a hindrance. Even it increases to 10, 15, 20,000 crores, it will not be an issue for us to manage. That is how we have constructed the fund. That is how we have built the framework, and we can you can be rest assured that it will be managed in a similar way, in an optimal manner, even at this size and even at a higher size.
Chirag, within equity allocation, what is the percentage of the large, mid, and small cap?
Within the equity allocation, it is about 75% large caps and about 20-25% mid caps. This is based on, or rather, it will be around 80% large caps and just about 20% mid and small caps. That is the kind of framework that will end up if you were to dissect the equity exposure that we have, because Nifty is all large cap. Quantum long-term equity fund will have about 20% mid caps and about 20-25% exposure to mid caps to the ESG fund. So overall, it will be not minimum 80% will be large caps and about 15-20% could be mid caps that we have.
Why can't quantum multi-asset fund of fund invest in other AMC funds or ETFs?
So we have designed it because given that this is a asset allocation product, and asset allocation, if you have look at studies, asset allocation determines usually 90% of the variability in returns that it produces, right? When we would have invested in other fund houses, there would be an element of dual expense ratios, dual management fees, which could be onerous on investors. We didn't want that, and we could execute the current multi-asset framework through the funds that we have. And therefore, we said that we will not venture into other fund houses, given that we do have the ability and expertise and options within our fund house to manage it in the way we want. So given it is a multi-asset product, and we do have the tools to create that multi-asset offering.
Sure. The next one again is a very targeted one. What are the benefits or options available for NRIs in this fund?
So NRIs do have similar options. You have the growth plan that is there. So you could invest in that, provided you are not a US NRI. Other NRIs can invest in this fund like you would invest in any other normal mutual fund scheme. So we will recommend, because we do not declare any dividends. We have not created that dividend plan. We just have a growth plan in there.
Sure. The expense ratio of quantum multi-asset fund of funds, is it including the underlying funds or excluding?
So if you're looking at 0.1%, which is mentioned on the fact sheet, it is just the expense ratio of the multi-asset fund. It is without the underlying. With the underlying today, it is at 0.58%.
Okay. But quantum multi-asset fund of fund returns is lower than its benchmark. Do you want to answer to that?
Yeah, so if you look at since some time, we have had a lower allocation to equities, given equities are kind of expensive since some time. Given that benchmark has a 40% allocation to equities, that has led to a better return for the benchmark. But benchmark is just for representation. If there is a risk in equities, we will not want to align it to the benchmark and take that over risk. Whenever markets fall, I think the benchmark will fall more than the fund, given it has a higher exposure to equities. And that time it will be, so it is just the phase of the market which is leading to a higher return for the benchmark today, given they have higher allocation to equities and equities doing or running higher each day. Once that kind of normalizes, that may not be the case.
Okay, so there's a question which says, how do we know the allocation percentage if we want to know after some time? Is there some place where the participant can actually check this?
So in our fact sheets, we do give our allocation to which fund, how much allocation we have. So if you kind of look at any previous fact sheets, you will have that allocation. So over time, if you want to refer what we had an allocation in Feb or March 2020, you will get that by opening that month's fact sheet. So it's very, very transparent. It's there out in the fact sheets every month.
Thanks, Chirag. I think that covers all the queries. Thank you once again for joining us on this webinar. The aim of every webinar is to share knowledge, insights, and information with you to help you on your wealth creation journey. Our speaker has tried to answer most of your questions. However, in case you have any further queries, please get in touch with us. You can visit our website, www.quantumamc.com, or get in touch with our customer care team. A recording of this webinar will be uploaded on the Quantum YouTube channel next week. Thanks, stay healthy, and stay safe.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.